We have a housing affordability crisis across the US, and politicians are looking for somebody to blame. But who is to blame? But before we jump into that, make sure you hit subscribe below to stay on top of all of the latest Huntsville, Alabama real estate news. So the latest target by politicians is large real estate institutional investors, but there's a lot more at play than just the large real estate investors. A lot of economic factors that are factoring into the affordability crisis that we have. One of that being the record money printing that we had during COVID-19. 40% of all the US dollars that are in supply right now came out of that period where we just printed way too many dollars, and so that's created high inflation and really affected affordability for first-time home buyers and really any home buyer right now as well. So record US dollar supply creation, and then the other thing was record low interest rates. Now, low interest rates helped create affordability during COVID-19, but it helped drive up prices. But as interest rates have now started to come up, as the Fed has increased the overnight rate, and that's affected the 30-year and 15-year rates, we still have high prices due to all that record money printing. And now we have also high interest rates, which is affecting the affordability across the US. On top of that, we've created what's called a mortgage rate lockdown effect, where a lot of sellers or a lot of homeowners, would-be sellers, have homes with mortgage rates locked in the high 2s, low 3s. And now with interest rates hovering around 7% or so, more than doubled what they were, a lot of sellers are simply not motivated enough to put their home on the market, lose that interest rate, and get a higher interest rate on the new purchase. And so that also is affecting affordability because there's a lot of demand that's not able to get met because there's a lack of supply. And so lack of supply in the marketplace is continuing to keep prices high and actually even driving prices even higher, as we've seen a 4.4% year-over-year increase here in the Huntsville market alone. So this mortgage rate lockdown effect has affected supply, but there's bigger factors affecting the supply in the marketplace as well. Pricing is an effect of supply and demand. And when there's not enough supply and there's more demand than that supply, prices are going to continue to go up, which is going to affect affordability, and whether it be houses or anything that you buy at the grocery store. And so that mortgage rate lockdown effect is one factor, but we really have the biggest factor is the housing deficit that we have. We have a housing deficit across the US of about 4 to 6 million homes, depending on whose research you use. But that all stems back to the post-Great Recession area, where basically banks simply stopped lending money to developers, and a lot of builders went out of business. And so there were fewer homes being produced post-Great Recession, but there were still new family formations continuing. And so that gap over that about a 15-year period has created about a 4 to 6 million home deficit across the US. So the government really wants to focus on large real estate institutional investors, and that has been part of the challenge. Historically, we see about 18% of the marketplace over the last decade or so towards real estate investors. So if there were 100 homes sold, historically about 18 of those are sold to investors. The challenge has been that has risen from 18 to 25, and typically really it's been kind of over this COVID and post-COVID period that we've seen that. The reason for that's been a couple of things. Number one is just the rise of cheap money. So Wall Street's had access to a really cheap money out there, and they figured out how to buy residential real estate at scale and manage that, because quite frankly, real estate is the best investment that's out there in terms of return on investment. And so Wall Street's always wanted to be able to get into that game, and they've been able to start to figure out how to do that over the last several years with lower interest rates. The other thing that has impacted that, because typically, the 18%, the majority of that has come from small scale investors. When you say small scale investors, you look at 1 to 9 units, but that extra 7%, a lot of that's really come from Wall Street money, large institutional investors, what you call iBuyers, these buyers that are buying your home for cash and then turning around and either flipping it or selling it to Wall Street. Or another group of investors, which is kind of that 10 to 99 period, where you have just a lot of real estate education out there now that's teaching what were kind of small mom and pop investors, teaching them how to scale up. And so what you've typically seen monopolizing this space has been 1 to 9 units. You're now starting to see large scale Wall Street money, and you're also starting to see mom and pop investors scaling up from 10 to 99 plus units in the marketplace. Now, investors in the marketplace is really kind of both good and bad. There's been periods where it's been good, there's been periods where it's been bad. The bad period has been over the COVID-19 period where there simply wasn't enough supply out there. There's a ton of demand with lower interest rates and homes still being affordable. So the competition with these large investors coming in and outbidding first-time homebuyers, I think is a negative effect upon the local economy as in general, and then also taking away from future first-time homebuyer generational wealth. So that's really kind of the negative side of investors, especially buying over the last couple of years. Now, the positive side of it is investors provide housing for people that are not looking to buy or not looking to buy right now and not looking to rent an apartment, but they want to rent in a single-family neighborhood. So that's a positive thing. The other positive thing also is investors help stabilize local markets. They buy in softer markets. You go back to that 2008 period, they really help stabilize the market there. And then as you see dips in the marketplace now, they come in and they help stabilize the real estate market, and really everybody benefits from that as well. Now, with some of these first-time homebuyers getting outbid over the last couple of years, that has increased the trend of what a lot of people are calling kind of #RenterNation. So home ownership rates are on a decline across the US, and they're at I believe it's like a 50-year low in terms of home ownership across the US, and those numbers continue to go down. And you can just drive around Huntsville and look at what the smart money is predicting. In every corner there's a new apartment complex or a build-to-rent type community. And so Wall Street and smart money is predicting that trend unfortunately is going to continue. And that is not a good thing for the middle class. That is not a good thing for society in general, because a lot of people build their net worth from home ownership. So that is one of the practical benefits of owning a home. The average net worth of a homeowner is nearly $400,000, $396,200 versus a renter, which is only $10,400. So about a 40 times spread between renters and homeowners. There's also a lot of emotional and practical benefits of owning a home with having your kids being able to have a backyard to play in and more space for a home office and all those different things. And a lot of people that are homeowners, you naturally have more civic pride and more involved in your community as well. And so that's a really important factor and something that we need to think about as we are potentially losing that with home ownership rates on the decline. And a lot of people might be wondering, how do you get that stat, $396 versus $10,000? Is it just that homeowners naturally have more money, they're better savers? Well, really the biggest factor is what I consider like the three main benefits of buying a home in terms of wealth. And then there's like this fourth bonus factor as well. And so as you map these benefits out over 10, 20 years, it's easy to see how homeowners increase their net worth to that $400,000 or so level. The biggest benefit to homeowners is appreciation. If the average home appreciates around 4 to 5% a year, or even more during that COVID-19 period, it is really easy to multiply your money in a way that you can't multiply your money anywhere else. And number two is a portion of your payment goes towards principal reductions each and every month. When you pay rent, 100% of that's interest that goes to the landlord's mortgage. You don't get to keep any of that. The third benefit is taxes. Uncle Sam has a lot of debt in this country, and you help them with their debt challenge by creating a mortgage. They incentivize you by giving you tax breaks for home ownership reasons. And then the last thing is rent continues to go up year after year due to inflation. With a fixed mortgage payment, your mortgage stays fixed for 15, 30 years, minus a little bit that could increase from taxes or insurance. Realistically, retirement is a huge goal for a lot of people in this country. It's almost impossible to retire if you don't own a home, because rent is going to continue to go up year after year, and you're just never going to be able to keep up with that without being able to get your house paid off and start to build that net worth. So how do we fix this challenge that we have across the US and here in Huntsville? Well, number one, I think we can provide or look at providing tax incentives for real estate investors to sell their inventory and really focus on those small investors because they have the majority of the inventory that's out there. And so we have a supply challenge in this country. There's still the demand. How do we fix affordability? Well, if we can increase the supply to help match the demand, that will help slow down the affordability gap that we have in this country. So number one is tax incentives for real estate investors. Long-term considerations is really kind of keeping an eye on Wall Street and what their goals are moving forward. If they continue, these large investors, and we have even more and more Wall Street money coming in, that captures a bigger percentage of the overall purchases in our country, and home ownership rates continue to decline, you may have to unfortunately look at legislation to help slow down some of the buying from Wall Street investors and large corporations. With the affordability challenges that we have across the US and multiple reasons for that, really the only way to protect yourself in this environment where we have low affordability and interest rates at higher levels, and even with that we have a 4.4% year-over-year increase, the only way to protect yourself is by owning a home. And if you don't own a home currently, and you don't think home ownership is for you, or you want to see if home ownership is for you, reach out to us. We have free buyer consultations. We love working with first-time home buyers to walk you through the process and see if you can get in a home and start building generational wealth for you and your family.